there are two types of insurance companies. Some are admitted and non-admitted. What's the difference between the two?
So that's a great question. So admitted insurance companies are the traditional companies that we think of, the ones we see on TV or hear on radio or see on the web. State Farm, Farmers, Geico, AAA, USAA, you name it, right? And these companies are admitted, that is, they're fully licensed to write insurance in this state or any other state in which they're licensed. They're also regulated. Oftentimes their rates are regulated, their reserves are regulated, various aspects of how they conduct themselves are regulated. Then there's another market that's deregulated called the surplus lines market. That's companies like Lloyd's or Zurich or other companies where they're allowed to sell insurance. The price is not regulated. A lot of the aspects of what they do is not regulated, but they're still allowed to sell insurance in the state. So it's an additional market that people can have access to. It's oftentimes more expensive because there's no rate regulation associated with it. It's also a market that you have to access through a particular specialized broker called a surplus lines broker. So this is a lot of information, but what you can do is you can go on the web and browse for surplus lines broker, find one near you, and then those are the individuals that can access the surplus lines market and then help you access surplus lines insurance.
Now, what's the difference? Which one is better? Do the admitted ones, are we clear that they have the funding to pay, or?
Well, so I think there's more regulation around the admitted carriers, and I think there's more security in that their prices are regulated, as well as the conduct of the companies are more regulated, and also their reserves are heavily regulated. The surplus lines companies, they are regulated in their home state, but they're not regulated very much at all in the state in which they're selling insurance, right? So what you're then relying on if you're buying insurance from a surplus lines company is that whatever country or other state that is regulating them is on the job. And, that can be kind of a mixed result sometimes. But I think by and large, the surplus lines companies do a good job. It's just also much more expensive, right? Because there is no rate regulation associated with the surplus lines companies. It's entirely free market. And as a consequence, they charge a lot and a lot more than the admitted carriers.
You anticipate the insurance rates to go up. And do you have a prediction what are the ranges that it might go up?
No, I don't. I do know that based on the regulatory changes that the insurers asked for and got this last year, that they're planning to submit requests for substantial rate increases. Could be 10, 20, 30, 40, 50, 60%. And it might vary. It will vary based on the nature of risk that your particular home faces, because the insurers are also allowed to charge riskier homes more than less risky homes. So it'll be substantial. And then you have, on top of that, the $20 billion and counting losses from the wildfires in Los Angeles. And so the insurers are not allowed to recoup that all at once this next year, but over time they are allowed to raise their rates to recover a substantial amount of that, and they will. So the rates were already going to go up. Now they're going to go up even higher as a result of these wildfires.
Now, when we talk to the insurance industry, they told us that the reason that the rates have to go up significantly is because California has had really low rates for a long time. What are your thoughts on that?
Well, I think most Californians would disagree with the assertion that their rates have been low. And in fact, over the last 5-6 years, rates have been going up quite substantially. Maybe not as much as the insurance companies would like, but they have been, in real objective and absolute terms, been going up a lot. And now they're going to go up even more, right? And so I don't think that the insurance crisis in the state of California is principally driven by an inability to get rate. They have gotten rate increases. It's driven by a dramatic increase in the risk and the losses the companies are suffering. And we're not unique in that regard. There's some 18 states across the United States that are seeing insurance companies raise rates and also decline to write insurance. And in some states, it's even worse. Florida, for example, where it's highly deregulated. The rates are 4 times the national average. the insurance companies have gotten everything that California asked for some time, including the ability to use probabilistic models and rates to include reinsurance costs and rates. There's also 2 taxpayer-funded nonprofit reinsurance facilities to provide cheaper reinsurance for the insurance companies. Whole long list of things, right? But even with all of that, the national carriers, the national insurers, have concluded they can't make money writing in Florida. So Florida is an example where even with the most lax regulation, even with the highest rates, the national insurance companies have decided the risk of loss and the magnitude of loss is just too much for them to be able to write insurance. Now, we're not as bad off as Florida, but we're on that trajectory. And they're also creating new sorts of perils that we really didn't have to deal with before. Severe convective storms. If you had asked someone 10 years ago, what's a severe convective storm? They'd look at you blankly, even knowledgeable people, and say, I have no idea what you're talking about. Well, severe convective storms are now a major contributor to the overall insured natural catastrophe losses in this country and globally. 50% of the insurance losses from natural catastrophes in this country and globally were from severe convective storms this year and last. What are they? What is this? Atmospheric rivers, heavy rain, sometimes hail, heavy sustained rain, sometimes coupled with wind. And it's not the water coming down and flooding that's causing the insurance losses, because the private insurers don't cover flood loss. That's covered only by the National Flood Insurance Program. It's just the damage caused by the heavy rain itself. And it cost last year something on the order of $40 to $50 billion in insured losses. Well, that was never an issue. This is a new phenomenon, and the climate scientists tell us that it's going to continue. We'll continue to have these severe convective storms throughout the United States. It's Ohio, Iowa, Oklahoma, Massachusetts, Vermont, etc. So it's not just the Gulf and Atlantic states like Florida, Louisiana, Georgia, Alabama. It's the interior of the country. It's not just the West, it's the interior of the country. So really there's no get out of climate free card, unfortunately. It's happening all over, and it's having an impact all over, and it's only getting worse, and that's making it harder and harder for insurance companies to keep writing insurance.